The world must brace itself for continued temperature rise, compound heat waves, droughts, and sea level rise. Why? Because the IPCC's latest synthesis report has warned that there is hardly any scientific scenario in which the world can avoid such calamities across regions during this decade. Here's the gist of the latest IPCC report. Across the world, while policies and laws meant to reduce or prevent the emission of greenhouse gases have consistently expanded, gaps and challenges remain. The report has warned that even with the nationally determined contributions announced by October 2021, the global greenhouse gas emissions expected in 2030 make it likely that warming will exceed 1.5 degrees Celsius during the 21st century and make it harder to limit warming below 2 degrees Celsius. Against this backdrop, Business Standard spoke to experts to find out what they think about the report and its warning.
So the report is quite clear that compared to the previous assessment, which was 7 or so years ago, we are likely to see impacts at lower temperatures than we earlier thought. So 2 degrees and 1.5 degrees are political shorthands. These were the numbers embedded in the Paris Agreement. But in practice, what it says is try and limit warming as much as you possibly can. It shouldn't be read to mean that if we go to just to 1.55 degrees, things suddenly fall off a cliff face. No, but it's also not the case that it's smooth. It just means that we will see more impact the higher the temperatures.
The maximum temperature rise beyond which impacts will become truly catastrophic is 1.5 degrees Celsius above pre-industrial levels. Current emission levels, meaning the levels at which we are emitting greenhouse gases on an annual basis, will lead to us blowing past that 1.5 degrees Celsius threshold within this century, unless we make efforts to rapidly reduce the output of emissions that we are putting right now.
The warning isn't new. The United Nations Emissions Gap Report, released in October 2022, said that even the updated climate pledges by countries, including India, would lead to a less than 10% cut in projected 2030 greenhouse gas emissions. A 45% reduction was necessary by 2030 to limit global temperature rise to 1.5 degrees Celsius by the end of the century. But this could be one of the last warnings we get. Released on March 20th, the current synthesis report is the final summary under the 6th assessment cycle of the IPCC, which is also its last since its inception in 1988. On the same day that the synthesis report was released, Indian scientists who were part of the IPCC said that India was among the countries that faced the highest risk from the impact of climate change, ranging from heat waves to cyclones and urban and rural displacement. The economic impact is already visible. Heat waves cost India an income loss of 5.4% of gross domestic product in 2021. The Climate Transparency Report said that this was the highest such loss among G20 nations. Against this backdrop, what are the major stumbling blocks and possible solutions? The latest synthesis report said that while global climate finance had shown an upward trend since the 5th assessment report, current flows, both public and private, for adaptation were insufficient. This was hampering the implementation of adaptation options, especially in developing countries. The report also underlined the gap in funding to developing and poor nations for their energy transition and climate adaptation plans. To meet the Paris Agreement's 1.5 degrees Celsius goal, total climate finance must grow more than 10 times faster than current rates. Instead, the rate of increase has slowed in recent years. Total climate finance must reach $5.2 trillion per year by 2030. According to the World Resources Institute. This will mean an average increase of $460 billion a year.
While we may feel there's a strong case, and there is a strong case for the West in the sense to front the cost of this transition, they find it very hard to actually extract that money from within their political systems at a scale that are needed for countries as big as India, China, South Africa, Brazil, and so on. And so the question becomes, can you then attract private capital? But the challenge there becomes that a lot of the investments in places like India might be a bit more risky. But the somewhat good news is climate finance is not some little marginal conversation anymore. It's very much at the mainstream of discussions around global finance, around reform of the multilateral development banks.
Pointing at solutions, the IPCC laid emphasis on climate resilient development. To enable this and adaptation and ambitious mitigation plans, its prescription includes prioritizing equity, climate justice, social justice, inclusion, and just energy transition processes. The panel also called for enhancing adaptation outcomes by increasing support to the most vulnerable regions and for accelerating climate action by integrating it with macroeconomic policies.
When we make choices about infrastructure, we should be thinking about building it in a way that is resilient, for example, to coastal storms. When we think about our agricultural systems, we should be thinking about policies that support agriculture that are more resilient to climate variation. When we think about our energy systems, certainly we should be trying to lock in low carbon rather than going down the path of high carbon systems that are harder to unwind later. So it says, start thinking about climate change in the context of mainstream development decisions.
The good news is that the IPCC also provides a whole menu of options or solutions to address this crisis. The IPCC, for example, is quite specific. It points out that regulatory instruments such as emission standards, for example, which are driven by governments, can actually support deep emission reductions. Carbon pricing instruments, on the other hand, such as cap and trade systems, which are market-based instruments, tend to be less effective in emission reduction.
Clearly, the time for warnings and reports has passed. Action is the need of the hour. And as a first step, the global financial system must be aligned with the 1.5 degrees Celsius goal.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.